The flash crash occurred on May 6, 2010, when in a matter of minutes, the U.S. equity markets dipped a nerve-shattering 10% or 1,000 points, caused the entire world to take a closer look at algorithmic trading and in particular, high-frequency trading, HFT. HFT is conducted by sophisticated computers that use algorithms to place very large orders in a very short amount of time based on a range of market conditions. These computers have the ability to analyze and place multiple trades in millionths of a second. It has been estimated that a whopping 50% of all stock trades executed on a given day are placed by HFT entities. It has also been estimated that of all the orders placed by high-frequency traders, 95 to 98% are canceled before execution. Unlike traditional fundamental investing, where an investor considered the underlying value and earnings potential of a business before making a decision to buy, the strategy of HFT is the short-term capturing of profit in small price movements. HFT gained popularity following the infamous collapse of Lehman Brothers back in 2008. During this time, the market had very little liquidity, which prevented investors from selling their securities quickly enough to prevent further losses. While high market liquidity is essential for investors to achieve optimum buy and sell prices, many are now contending that HFT causes more harm than good. There is currently a worldwide debate on whether or not high-frequency trading should be more regulated by the SEC. Since this issue is one that essentially has the power to affect the trading prices and strategies of most of the world, let's break the topic down into the pros and cons of HFT and examine the effect of regulation by the Securities and Exchange Commission, SEC. As stated previously, HFT was originally designed with the intent to provide greater liquidity in the market. In other words, there are more buyers and sellers. This means that when I want to buy a stock, there are more sell offers available at a more competitive price. Another positive aspect of HFT is that it creates lower trading costs for investors. Because HFT creates an environment of more buyers and sellers, the bid price, or what people are willing to buy at, and the ask price, or what people are willing to sell at, are closer together. The closer the bid and the ask are to each other, the better, because it basically means that there are both liquidity and depth in the market. This translates to faster order execution times and the greater ability of investors to buy and sell their securities when they want to. One final support of HFT is that it prevents arbitrage. Arbitrage is the act of taking advantage of price differences across different exchanges. This happens when different exchanges holding the same security have slight discrepancies in price. When this happens, savvy investors make simultaneous purchases on the lower price exchange and sales of the security on the higher price exchanges for a profit. While great for savvy investors, this market inefficiency can potentially hurt the average investor. HFT essentially eliminates arbitrage by adding more volume to all of the exchanges simultaneously. It also removes arbitrage by exploiting it before anyone even notices it exists. Though it may seem unfair, the inexistence of arbitrage makes for a more efficient market. Now that we have examined all of the pros created by HFT, it is now time to consider the cons. Though HFT provides benefits to investors, it does so at a significant cost. While the full extent of this cost is still being researched, let's examine what is known for sure. The practice of front-running is both unethical and illegal in the United States. Front-running occurs when a broker-dealer trades ahead of their clients in order to acquire the lowest price on a stock. This in turn pushes up the price before the clients are able to buy. Though illegal for broker-dealers, HFTs have been front-running investors for years. For example, HFTs are able to detect incoming buy orders and then buy ahead of them. This increases the price, allowing HFTs to then sell to the client at a higher price. Another negative aspect of HFT is the potential for flash crashes. These are the result of glitches in the algorithmic programming of HFT computers, causing massive sellouts in a matter of minutes, which then sends the market plummeting. Probably the biggest complication of HFT is what it has done to market sentiment in the wake of flash crashes. Public confidence in the market has undergone a dramatic change for the worst, and small investors no longer have a sense of market fairness. Though the media generally takes a stance against HFT, it is important to understand the positives along with the negatives. It is also important to understand that the debate is still underway, and the SEC's official stance is one of not having enough information to take a side. In the coming debates, you now have all the information needed to understand this major issue. So with all this in mind, it is now up to you to weigh the pros against the cons and determine for yourself whether or not the SEC should regulate HFT or stop it altogether.